Howdy, everybody. Welcome to Liberty Call. Today is Monday, March 24th, 2025. Hope you're having a fantastical day out there. It's kind of gloomy here in Colorado, but it has warmed up, which is nice. All right. Markets are rallying to kick off the week with the S&P up about 1.6%, the Dow gaining 1.2%, and NASDAQ jumping 2.2% as traders cheer signs that Trump may take a more targeted approach to next week's tariffs. But under the surface, first quarter earnings forecasts are crumbling. Biotech firm 23andMe just filed bankruptcy, and the U.S. could hit $36 trillion debt ceiling as early as July. Meanwhile, Tesla shares are ripping higher after a brutal start to the year. So before we break it all down, if you could do me a favor, give me some thumbs up, a like, share, subscribe, and follow, and press the notification bell. All right. Let's get into the markets. Dow Jones was up 1.44%, 603 points, closed at 42,589. S&P 500 up 1.68, 95 points, closed at 57.62. NASDAQ up 2.27%, 404 points, closed at 18,188. VIX was down 9.23% today. It's at 1750. Canada up 1.34. Brazil down 0.81, and Mexico down 0.09. Excuse me. All right. In Europe, Germany was down 0.16. The UK down a tenth. France down 0.26. Netherlands up 0.09. Spain down 0.2, Italy down 0.16, Switzerland down 0.45, and Portugal down 0.35. Russian exchanges split today. MOEX down 0.37, RTSI up 0.54. And the overnight markets, the Nikkei in Japan was down 0.18, Australia up 0.07, New Zealand up 0.49. In China, the Shanghai was up 0.15, Shenzhen Component up 0.07, China 50 up 0.68. DJ Shanghai up 0.2%, Hang Seng up 0.91, and the Taiwan weighted down 0.75. All right. Good stuff. All righty. Well, let's jump into our weekly economic update. Stocks notched a solid gain last week as upbeat comments from the Fed helped stocks snap their 4-week losing streak. The S&P 500 rose 0.51%. The NASDAQ picked up 0.17%. The Dow led, gaining 1.2%, and overseas markets rose 0.75%. A solid week. Stocks opened the week higher despite weaker than expected retail sales. On Tuesday, stocks pulled back on disappointing economic data and renewed Middle East tensions. Stocks roared Wednesday as investors looked forward to the Federal Reserve's meeting. As widely expected, the Fed kept rates steady, but Fed Chair Powell's comments buoyed investor spirits. Stocks dipped Thursday and opened lower Friday, but investors showed some confidence by pushing prices higher into Friday's close. All right, the Fed is staying positive amid all the turbulence of late. The Fed was a steadying influence at his post-meeting press conference. Fed Chair Powell stressed that the economy remained strong and suggested that any impact from tariffs on inflation would be short-term. Where have we heard that before? Oh yeah, Janet Yellen in June of 22. But the primary reason investors cheered came down to this. The most Fed officials still penciled in 2 interest rate cuts for the year. In late January, Powell said the central bank was in no hurry to adjust its policy stance, which unsettled the markets. Key economic data this week. Monday, we have the PMI composite, services and manufacturing. Tuesday, the Case-Shiller home price index and consumer confidence and new home sales. Wednesday, durable goods orders, and St. Louis Fed President Alberto Musalem is speaking. Thursday is GDP, trade balancing goods, weekly jobless claims, retail and wholesale inventories, pending home sales, and Richmond Fed President Tom Barkin will be speaking. Friday is the personal consumption and expenditures index and consumer sentiment. A handful of companies reporting earnings this week. Tuesday, McCormick and Company Incorporated and GameStop. Wednesday is Cintas and Paychex, and Thursday is Lululemon. Stuff. Let's hop into our market recap. S&P 500 rallies on hopes of softer tariffs. Well, they can hope. All right. U.S. stocks rallied Monday, driven by a strong rebound in tech stocks as investors reacted positively to reports that upcoming U.S. trade tariffs under the Trump administration will be narrower and less severe than previously feared. Softer tariff scope calms markets. Bloomberg and Wall Street Journal suggest tariffs will be limited to about 15 countries, avoiding broad sectoral measures. While concerns remain about inflation and trade disruption, investors look took comfort in the reduced economic threat. Trump has referred to as April 2nd as Liberation Day, but the targeted nature of the tariff has softened expectations of immediate economic damage. Fed Watch and economic data on deck. Investors are focused on Fed speakers this week for insights into monetary policy following the Fed's recent comments on uncertainty from Trump's policies. Key economic reports, including the PMI data, Q4 GDP revisions, and PCE price index, a major inflation gauge. Some corporate movers. Tesla surged over 10% as dip buyers returned despite recent volatility and reports of a Texas showroom incident. Nvidia rose more than 3% as reduced tariff fears ease investor concerns. 23andMe collapsed 51% after filing Chapter 11 bankruptcy. James Hardie dropped 12% after announcing a $9 billion acquisition of AZEK. And Gold Fields fell 2% after its $2.1 billion buyout of Gold Road Resources was rejected. Wall Street got a breather from tariff panic, but it's clear that it's clear the global economy remains one Trump tweet away from a trade skirmish. Yeah, well, people get too wound up over the little stuff. All righty, well, let's get to our next article here. Comes from Zero Hedge, Devaluing the U.S. Dollar, How to Make America Poorer Again. This was written by Daniel Lacal. All right. Daniel Lacal critiques the rumored Mar-a-Lago Accord as a proposed U.S.-led effort to devalue the dollar to boost exports and ease debt pressures. Inspired by the failed Plaza Accord of 1985, this strategy, he argues, rests on flawed assumptions and could backfire dangerously. Contrary to belief, U.S. exports are not low because of a strong dollar, but because the U.S. has a self-sufficient, consumption-driven economy with services comprising of the bulk of GDP, harder to export than goods. The U.S. is also rich in natural resources and a host of the largest retail market in the world, minimizing its reliance on exports. Lacal warns that artificially weakening the dollar would only spur inflation, harm savers and workers, and undermine global confidence in U.S. debt and the dollar's reserve currency status. Swapping short-term debt for 100-year bonds would encourage more reckless spending while frightening investors. He emphasizes that devaluation doesn't boost productivity or competitiveness. It simply erodes real wages and enriches crony sectors while pushing the economy towards long-term decline. Countries like Argentina and Venezuela are evidence that currency debasement leads to economic ruin, not prosperity. Instead, Lacal advocates for structural reforms, reducing government spending, which most people are for, fixing regulatory and tax burdens, again, positive, and embracing sound monetary policy. So, again, something I can't disagree with. A strong U.S. dollar, he contends, controls inflation, attracts global capital, supports real wage growth, and preserves America's economic leadership. Devaluation is a shortcut to mediocrity. A strong dollar isn't a problem. It's proof that the U.S. is winning. Well, I don't know about winning, but, doing better than everybody else. That's probably what I would say. All right, last up from our friends over at First Trust, Mr. Brian Westbury, his Monday Morning Outlook, symptoms or causes. So let's see what he said here. Despite deep political divides, most Americans agree that something went wrong with the U.S. economy in the last 60 years. Common concerns include slow economic growth, rising inequality, unaffordable housing, and a shrinking manufacturing base. The left blames greed and capitalism, proposing higher taxes and wealth redistribution to fix these issues. I don't think it's greed. I think it's crony capitalism. Often framed through the lens of climate change. The right, often represented by Robert Lighthizer, blames hyperglobalization, arguing that outsourcing manufacturing destroyed both the economy and social cohesion. Maybe. But both sides the author argues, are treating symptoms, not the root cause. The real issue, the massive expansion of government, particularly non-defense federal spending, which has ballooned from 7% of GDP in the 1950s to 23% today. When you include all government levels and regulatory costs, government now influences or controls over half of the economy. The crowding out of the private sector limits growth, depresses savings, and drives up the cost of essentials like housing. The result of sluggish productivity, a weakened manufacturing base, and economic stagnation, issues too often blamed on capitalism itself. The solution, shrink the government, not capitalism. Rather than chasing short-term fixes like protectionism or redistribution. The long-term fix lies in restoring a smaller, freer economy where the private sector thrives and prosperity can be built organically, not engineered through bureaucracy. 100% agree. Yeah, get rid of the government. We have plenty of government. I've got a county. I don't know. I don't live in a city, but I can go to several cities nearby. And then I got the state above that. Why do I need a federal government? All they do is, take a third of what I make and blow it up on the other side of the planet. So anyways, all right. Well, that's everything that I had to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call. I'll be happy to help. All right. Well, hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.